Good morning and welcome to African Bank's 2025 financial year results. These results take place in a seminal year for us, a year of our jubilee. We're celebrating 50 years of African Bank, and that's the golden thread in what we're presenting today over our ordinary CI. We start this conversation about the 2025 results by reminding ourselves that the Accelerate strategy that we adopted in 2021 continues to strengthen and expand African Bank from where we were, a micro-lender, into our ambition of becoming a true bank for the people, by the people, serving the people, a bank that would be customer-centric, data and digitally enabled, that is diverse, that is scalable, that is sustainable, and has a compelling listing proposition for investors, for our customers, for our people going forward. This strategy has stood us well. And just to recap, that whilst we're evolving a 50-year legacy, we are still very much a 5-year-old, fully scaled banking proposition in this market. On a path that is determined to build from a monoline retail lender, a diversified, scalable, sustainable bank that offers personal banking, business and commercial capabilities for our chosen markets. But let's remember where we were in 2021. A monoline retail bank with these features in front of us. Now, to realize our ambition, we needed a larger footprint, broader products, and more transactional customers. We needed to build new capabilities and solutions to re-enter the small, medium enterprises, entrepreneur support, and banking commercial clients. This is what we needed, and what we've done over the last 5 or so years is to strengthen the core of our retail business through a number of digital journeys, strengthening our sales team, investing in our IT systems, ensuring that our sales teams are retrained to sell more than just micro-lending product. But for what we couldn't do ourselves, what we couldn't build ourselves, we went out to buy capabilities that were in Grindrod Bank and assets and liabilities of Ubank. We went out to establish new partnerships, new alliance partnerships with MTN Momo, with Lesaka, with Shoprite Checkers. We went out to acquire Sesfin assets that also further added capabilities in business and commercial. And this year, we further launched digital SMME solutions. This enabled us to get the right people in the business, get the right asset book and liability book, get the right partners to walk the journey with us and expose us to an enlarged customer segment, get our footprint and our distribution just right. But of course, with a new strategy, structure has got to follow strategy. And so we were clear to launch a new operating model that ensured that we could integrate our people, our systems, our capabilities for one African bank, and not just amalgamation of all of these banks and these capabilities. A structure that follows strategy is one thing, but for successful integration, we were quite clear that we needed a new culture, a culture that would show us what it means to be a leader at African Bank. A one African Bank culture. And this is underpinned by a leadership compact that is our commitment as leaders at various levels of this organization, ensuring that our integration is not just in systems, people, and processes, but it is also in how we decide to show up as African Bank, a one African Bank culture. This has enabled us at this time to have strengthened personal banking from just one product to almost full suite personal banking capability, and of course from almost nothing 4 years ago to now have a flourishing business and commercial banking franchise. During this period, this enabled us, what we needed to do, what we've done, has enabled us to move from active customers of 1.5 million in 2021 when we launched the strategy to 6.3 million customers today that are active. In other words, customers that trade with us at least once a month. We've moved from a non-interest revenue of 479 million to a 2 billion rands non-interest revenue this year. Gross advances shy of 27 billion to over 44 billion in this reporting period. Retail deposits 10 billion to 37 billion. Total assets of 29 billion to 58 billion. And of course, whilst relatively sticking to very strict risk parameters, moving our credit loss ratio from 4.9% to only 5.3%. This has been how we've evolved this 50-year legacy in 5 years, from a monoline microlender into a fully scaled banking capability. And so we now have an opportunity. We have an opportunity to consolidate these capabilities that we've built, to really double-click on this ambition of building a customer-centric, data and digitally enabled, diverse bank with scale that's sustainable and has got a compelling listing proposition for investors. Because of what we've done, in the parameters that I've just spoken about, we now have an opportunity to consolidate these capabilities, to drive data and digital enablement, to advance our ways of working and be much more focused to create, from what we've done already, long-term value, sustainable long-term value for stakeholders. And we will do so and achieve higher fee income revenue and operational efficiencies and an ROE that is sustainable and attractive. And maybe to just double-click on the jobs to be done to get this long-term sustainable value extraction. In the capabilities that we've already got, we are going to continue to advance new products to deposit growth. We are going to continue to grow our customer numbers above 6.3 million. We are going to continue this year to have an embedded insurance product, not just for our loan products, but for the entire franchise. We are continue to support, as we acquired this year capabilities in home loan solutions. We are going to support the development of that offering for our customers in personal banking. And of course, support further investment in business and commercial secured assets. Our journey in data and digital enablement is being about revising our employee value proposition for the data and digital communities that are a very rare skill, not just in South Africa, but globally. Sets of communities, data and digital communities that are a huge impetus for the kind of bank that we want to be, to increase online transactions, to enhance our biometric security platforms and ensure that we are a digital always bank for those customers that prefer this channel. One of the big advances we are making in extracting better and long-term value for stakeholders is to actually ensure that we pivot our ways of working into agile ways of working. This will enable us to improve disciplined execution in a number of tasks and initiatives that we are about. But importantly, it will also help us improve efficiencies, remove wastes that are all over an organization that has been on a growth mode for as long as we are. And this we achieve through being a lot more focused in our priorities, a lot more clearer in work that must be done and what must be stopped. And our priorities are very clear. It is ensuring that our customer journeys are frictionless, are smooth, and are efficient. It is to ensure that we embed our data and digital transformation faster and better. It is to ensure that our end-to-end credit processes actually make us more competitive and support the new capabilities we've got in both secured and unsecured lending. And by so doing, in the next 3 years, ensure higher fee income and revenue from transactional accounts, from a mix of secured and unsecured assets growth, from a higher deposit base in retail and business banking, and ensure a much lower cost-to-income ratio through improved efficiencies, faster digital transformation, and resource capability optimization. I spoke about this 5-year strategy and how it's been delivered to date. When we set out this strategy, we contracted a set of targets that ought to have been achieved in 2025. And if you look at those targets and where we stand today, in terms of net advances, we had committed to be above 30 billion. We actually are over 44 billion. In terms of retail deposits, we said there should be a ratio of 70% retail deposits in our total mix. We are over 85% as we sit here today. In terms of credit loss, we had said the organization will have to take more risk to achieve these ambitions. In fact, we haven't. And we've only moved from 4.9% to 5.3% in terms of CLR in this period. We committed that we couldn't be truly a bank for the people in South Africa without being a broad-based BE level 1. And we moved from level 4 at the time to level 1, and we've maintained this even with the acquisitions that we've taken along the way. We had committed that we'd have 3.5 million customers, and then we adjusted this to just over 5 million. We're reporting today that we are in fact at 6.3 million customers. So we've shot the lights off in terms of most of the targets set in 2021 for 2025. And this is testament of the heavy lifting that's taken place. And I commend colleagues at African Bank who've worked tirelessly to ensure that we do both this organic heavy lifting and the kind of inorganic growth, acquisitions and various banks of various capabilities not seen in this market in a long time. However, we also note that we have not met expectations. We've not met our own expectations in terms of having a cost-to-income ratio less than 50%. We've not met our expectations in terms of reaching a net profit after tax number of 2.5 billion. We've not met expectations in terms of driving ROEs in the mid-teens. And that is why we are very clear that the consolidation of these capabilities to extract long-term value starts now and starts by ensuring operational efficiencies to lower operating expenses, faster digital transformation, and resource capability optimization to address these remaining key deliverables for us to have a compelling listing proposition for investors. But I must also remind us that we've been very clear in this time to choose where to play and how we will win there. We are a bank of a mission. We are a bank of necessity that's got a clear niche in this market. And that niche we define, if you look at the pyramid of customer segments, both personal and business customer segments, we define it as being an expert in the middle of the pyramid and the bottom of the pyramid, both in terms of personal banking, to be that premium salaried banker, but also in the middle market and in your mass market where you have a lot of your entrepreneurs, self-employed people, and those that are in not so salaried type of employment. That's where we choose to play. It is a play that is consistent with the markets that we've served, even when we were just a microlender for the last 2 decades. In the business space, again, consistent with who we are as a bank and what is in our DNA as a bank founded by entrepreneurs. We choose to be a bank that will be an expert in the middle of the pyramid and bottom of the pyramid, ensuring that our centerpiece is in supporting entrepreneurs and supporting SMEs and those commercial and grown SMEs into commercial and higher segments that still want us to serve them will be available to serve them. We've set up, not over the last 4 years, a strategy to acquire stuff. We've set up over the last 4 years a strategy to acquire capabilities that enable us to have winning offerings in each of these segments, both for personal banking franchise proposition and in business and commercial proposition. Whether it was in acquiring the guardrails of Green Road Bank that gave us a good commercial property finance, the good capabilities to support conveyancers and industrial firms, or in adding in there the trade and data finance capability that we got from CESFIN, or the commercial development finance capability from there, or the business transactional capability from there. All of that was geared so that we could support these segments. And so we now have an opportunity to enable operational capabilities and focus on driving growth and long-term value from this franchise that we now have. But we do not operate in a vacuum. We in fact operate in a very dynamic market in South Africa that is influenced by global events. And so we have to continue to navigate the changing operating environment so that we adapt both our offering and our posture. South Africa is today with a rather optimistic growth outlook. The S&P's upgrade of South Africa's sovereign rating for the first time in 2 decades is encouraging, and notes the easing inflation, lower interest rates, both currently and expected interest rates, ongoing structural reforms supported by a great partnership between private and public sector. We laud the work done in the Vulindlela work streams led by the Presidency and Business South Africa, and also a much more stable fiscal situation that is aligned with monetary policy. Governance improvements and private investment in renewable energy has brought about energy stability, and we look forward for logistics stability as the work goes into stabilizing the ports and Transnet, the key backbones of our economy that remains export driven. That said, though, our operating environment still has elevated cost of living that brings about pressure in terms of household disposable income. And so we have to assist customers through their life journeys in how they manage their exposures and their financial stability. Geopolitical uncertainty remains, albeit that there are green shoots in the easing of global conflicts and also bespoke trade tariff negotiations taking place between the US and other key trading partners for South Africa that are important for so many of our SMEs, for so many of our commercial clients, and significant employers to our personal banking customers. The removal of South Africa from the FATF grey list has restored investor confidence, but also eased the burden of banking flows between ourselves and other countries, and we laud this improvement in terms of the operating model that we work in. We endeavor to continue delivering solutions for our operating market that advances financial inclusion as well. And now maybe an overview of our financial results in FY25 from my end. Our Group CFO, Anban Chetty, will come after me to present the detail of these results. I'm hoping that having sketched the path that we've traversed in evolving this 50-year legacy in the last 5 years, in bringing about capabilities that have enabled us to transform from a monoline bank into the fully fledged personal business and commercial bank that we are today. That continues, and how it's shaped these results this year is one, of course, continued customer growth. We're really chuffed that we are announcing 6.3 million active customers in the year 2025. We continue to register milestones, significant milestones, in diversifying and de-risking our balance sheet with assets of over 58 billion rands this year and improved non-performing loans at 23% this year. Our total asset growth was largely driven by business and commercial this year from the new capabilities that it's got in secured assets, particularly commercial property, capital equipment assets. However, we were also deliberate this year to reconfigure our personal banking credit and risk models within the unsecured lending asset class. We're clear that we needed to take a pause to improve our credit granting models, rehabilitation processes that enable us to walk the journey, the credit journey with our customers in unsecured lending much better, and also strengthening both internal and external collections capabilities so that we limit the amount of credit impairments that we take, and we are a lot more better in selecting how and where we grant our credit, in line with what I've described later as a conscious decision of where we want to play and how we want to win there. This has resulted in us reducing this year our net advances in our biggest asset class, which is unsecured lending. The growth in customer deposits and better debt market appetite is a key feature of our results this year, and so is our continued growth from almost nowhere in transactional revenues, with our My World accounts and personal banking and business transactional accounts being supported by a winning audacious rewards program and value-added services. I spoke earlier about capabilities that we've had to bolster on to ensure that we offer full service for our customers. This year has seen us take off new once-off capabilities from SESFIN in terms of capital equipment finance, commercial property finance, trade and data finance. It's also seen us take new once-off costs and capabilities related to building our personal banking home solutions. These have added to the cost of our implementation this year in particular, thus leading to short-term adverse impact on our profitability. This is the overview of our 2025 financial results. I shall now call on my colleague Anban to give us detail of these results. Anban?
Thank you so much, KGB, for providing such a comprehensive summary of our Accelerate strategy. As I move forward, I'm going to give you all an overview of the group's financial performance, and I'm going to start off with net profit after tax. Net profit after tax is currently at 274 million, quite muted from where we were at last year at just over 500 million. Albeit, we have made significant investments in our capabilities, people, processes, and systems, and we're going to spend a lot of time in the coming financial year on focusing on gaining those efficiencies. That link to comes in with a lower ROE of just over 2%. What's been quite positive is that our impairment charges have come in at 2.4 billion, lower than last year at 2.6. We have seen an improved group NPL ratio of 23%, which really assists as we work on our balance sheet as well from personal banking and business and commercial, diversifying, and we're managing our credit risk. What's also been really noteworthy is that our customer deposits is at 37 billion, coming off last year at 33 billion. We certainly have focused on gaining efficiencies, albeit our cost to income has come in at elevated levels of 64%, and there's still going to be a lot more focus on our new ways of work, driving that into the future to ensure that we can contain the cost to income. If we look at our strong liquidity, 7.4 billion, coming off a year ago at 6 billion, albeit with a balance sheet that has grown. So we've really seen strong deposits coming in, as well as when we've entered the wholesale market, we've seen very pleasing results being oversubscribed in our bonds, as well as with compressing margins. Altogether, that's also supported by our capital adequacy ratio being at 28.4% in a growing balance sheet. If we move on to some of the income statement levers, we'll start firstly with the non-interest revenue. What's been pleasing is that we've diversified our balance sheet, and very pleasing that our non-interest revenue has grown to over 2.1 billion rand, as we have more customers on our platform who have been transacting on their My World account or swiping their credit card as well, or using us for their value-added transactions like airtime and data. So we've seen really good diversification and growth in our non-interest revenue. If we move on to our insurance income, you'll see that we've seen quite a decline at 582, coming off from a year ago at over 800 million, combined by a few things. Firstly, as we have seen, our personal banking balance sheet and our unsecured lending has been lower. That has led to lower premiums. So therefore, it results in lower revenue from our insurance income. We've seen slight benefit from our insurance claims being at 710 compared to 720, as well as last year was the implementation of the new accounting standard called IFRS 17, and that creates that mismatch in our earnings from the 800 coming down to the 582. If we have to move on to the credit impairment charge, what certainly has been pleasing is that personal banking continues to see a reduction of the impairment charge, and that comes in with much better credit risk management, looking at from the collections, stable systems, call center efficiencies, as well as book sales that we have done. Business and commercial also lower year on year. You'd recall last year we had a single counter in the transport industry that had elevated the charge, and this year is much more stabilized, coming in from a business and commercial. Overall for the group, the impairment charge is just over 2.4 billion compared to a year ago, over 2.6 billion. From a credit loss perspective, personal banking seeing slight bit of benefit at 7.5%, at a year ago at 7.6%, compared to business and commercial, significant benefit, having a credit loss ratio at 1% compared to last year at 2.3%. If we've got to pull it all together for the group, really good benefit at 5.3% compared to a year ago at 6.3%, speaks to diversification, speaks to much better credit risk management across all the value chains in the group. As we focus on our operating expenses, an important data point is, you'd recall when we did our half-year results, operating expenses year on year was up 16%. When you look at our year-on-year operating costs at a full year, it's at 11%. We've already started focusing on efficiencies, and you'll see that come in our marketing and other costs, already down 3 and 10%. What we have invested on is on IT and our staff costs. It's been a key priority to ensure that we are investing in our IT infrastructure, in digital, as well as we've acquired capabilities, and with that we've also acquired people as well. So the key focus, but even looking ahead, we're going to continue on the efficiency drive as we look at our new ways of work and we look at agile methods of doing things more efficiently. If we have to move on to our gross advances, what you'll notice is overall muted growth at 44 billion, coming in at just around 4%. But if we have to take a slightly closer look into our business units, personal banking, we've really focused on enhancing our credit. We focused on working our non-performing loans, enhancing it, doing debt sales when we needed to align ourselves to industry. And that speaks to the reduction of that gross advances at 27 billion compared to a year ago at 31. If you have to look at business and commercial, really exceptional growth coming in a year ago at 11 and this year being at 17 billion. It speaks to the acquisitions that we've acquired from Sasfin, Capital Equipment Finance, as well as their commercial property finance, as well as organic growth. As we build the brand of business and commercial, we've done a lot more transactions and more clients have come into the business and commercial platform and into our ecosystem. If we look at the non-performing loans, we've really seen great improvement from a group sitting at just over 23%, a year ago at 33%. And if we take that slightly deeper into personal banking, really exceptional performance, coming in, having an NPL at 29% and getting closer to market compared to a year ago at just under 38%. In business and commercial, we're just under 14% compared to a year ago at under 20%. Pulling this all together once again speaks to huge amount of effort being done in our credit risk management in terms of our loans, as well as moving into secured lending as well, which we expect to lead to lower NPLs. If we move and we focus onto our My World or customers and deposits, what's really pleasing, if you look at the graph on the top, you'll see that number of transactions and the value of transactions continue to increase. And that is as more customers come into our platform, more customers open My World accounts, more customers getting credit card, and more swipes. Very positive result coming in. If we look at overall My World, the accounts that have been opened and funded, 3.6 million have been opened and 2.1 million have been funded. And you see that growth coming in, which is really pleasing. Even from a business and commercial perspective, we're growing off a low base in the SME market and also entrepreneurs as more customers come in and find African Bank as their client and bank of choice. If we have to look at our total advances by channel or distribution network, you'll see that very importantly is that more customers choose to chat to us via the call center as well as use the app. So you'll see that growing up to in total of 34%, a year ago being at 30%. So it's really pleasing that more customers join and take applications or advances through other channels as well. And then you'll see how we've invested in all our channels, being the call center, our app, and our branch network. 65% of our total advances still come from our branch network, albeit lower from last year at 70%, but it shows the importance of having a branch network of over 420 branches. If we have to look slightly more specifically into credit, you'll see that customer loan applications has grown to over 1.6 million, coming off last year at 1.4. So the demand for credit is there. Customers still come to all our channels, and When they receive an offer, 55% take it up, which is really pleasing because they choose African Bank as their bank of choice to take up their credit. Now if we come into the capital and liquidity, which is very important from a bank perspective, you'll see our capital adequacy ratio is at 28.4%, well above our minimum requirements, albeit on a growing balance sheet. And as we diversify, we expect our capital adequacy to be reducing as we grow our balance sheet as well and diversify into secured lending. From a group diversification in terms of the funding, a few years ago, 61% of our balance sheet was funded with wholesale funding. If you move on a few years, that is only now at 15%, which is really pleasing as we've gone into the wholesale market. We've seen appetite in our bond issuance. We've been oversubscribed, margins have compressed, and we can see the investors are seeing African Bank much more positively. 85% of our funding now comes in from our personal banking as well as business and commercial business units. In conclusion, what we're really going to be focusing on and what you've heard is that we've invested in people, systems, processes, partnerships. We're creating value. Albeit you'll see it not coming through into the earnings just yet, we certainly want to invest and gain those efficiencies in the coming year as well. We will continue to scale our secured lending. We'll continue to diversify. We'll continue to focus on transactional banking, digital, non-life insurance products as well. And we go to business and commercial, we'll continue to focus on growing our asset base in a low-risk environment. Our increased deposit base has really been positive as we deepen our customer journey and experience, and we'll continue doing that within our personal banking and our business and commercial. KGB has spoken about new markets and digital, and as we come into the conclusion, I think what's really key is that we've done a lot of investments. You'll see that coming through in our elevated cost to income. What we're really going to be looking into the future is working on agile ways of work, ensuring that the investments we've made, we can get that and turn that into higher levels of revenue. And we're also going to be focusing on where we have too much of cost. How do we focus on removing that cost base out of our cost and driving that into our revenue as well? In summary, we have made investments in acquiring critical capabilities in people, systems, processes to support our Accelerate strategy. Given that momentum that we have now on our balance sheet diversification and revenue, we are now focusing on extracting efficiencies from those investments. Thank you so much, and I'm going to hand over to KGB to come in to the concluding remarks. Thank you again.
Thank you, Anban. Thank you for giving us a detailed look at our financial performance in 2025. In closing, our journey to build a bank for the people, by the people, serving the people remains on track. In evolving the last 50 years' legacy of African Bank, and in particular, the 5 years we've now had with Accelerate 25 strategy, meant to build from a microlender a customer-centric, data and digitally enabled, diverse, scalable and sustainable bank that has got a compelling listing proposition is on track. In this period, we have built capabilities, we have bought capabilities, and we've partners for capabilities that enable us to have a franchise that we can now extract value from with our expanded capabilities and this strengthened franchise. We do acknowledge that this year in particular, with less than satisfactory NPAT, given all the investments we continue to make, we need to pivot our ways of working so that we can improve efficiencies. We've got an established foundation that is scalable, that enables us to have sustainable growth and to have long-term profitability that is stable, that is predictable. Through agile execution, we aim to improve efficiencies and prioritize customer journeys, data and digital transformation, and of course, the end-to-end credit journeys that our customers go through in both secured and unsecured lending. We continue to build all of this on the strength of strong governance, resilient compliance, and enhanced risk management. With these expanded capabilities and with this strengthened franchise, we committed to pivot our ways of working so that we can extract value and ensure that we, in addition to meeting all the other targets we set ourselves in 2021, that would be targets that make us a compelling listing proposition for investors. We also strive in the next 3 years to ensure that we get to an ROE in the mid-teens, to an NPAT number that's compelling, and a cost-to-income ratio that displays efficiencies as a business, and thus rendering us attractive in the short and in the long term as an investment proposition. This year's numbers show that we've made these advances and we can back ourselves to now target where we should be in all of this proposition. I want to take this time to thank you for joining us and listening to our story. But I also want to thank you, our customers who voted with your feet, from 1.5 million customers just 4 years ago to over 6.3 million customers. I want to thank our investors who voted with confidence, giving us Tier 2 capital at ever-improving spreads and also investing in our listed debt. I want to thank our board, which has supported us, guided us, steered us in this path and in the execution of this strategy up until now. I also want to thank our movement makers, African bankers who, with their blood, sweat, and tears, wake up every day to show up with their A game in how we serve our customers, how we service our customers, and how we show up for one another. I'm grateful for this time and thank our shareholders who've given us the license to do business and the capital to do the stuff that should really enable South Africa to have a bank for the people, by the people, serving the underserved, underserviced people of our country. Thank you very much. And now I wish to invite us for questions and answers session.